Hi, my name is Jason Martin. Welcome to Allgen's Market Update. Today is September 20th, 2019. So I want to give you an update on the market, the economy, interest rates. So let's hop right in here. So if you've been watching these videos over the last few months, you'll notice here this top bullet point is similar to last month's update because it's still giving the same reading. So the S&P 500 reaches an all-time high with a little conviction again. And what does that mean? So this is a chart I've shown over the years where if the market, this is the market being the S&P 500, if it's going up, then your momentum indicator, in this case the relative strength index, should also be going up. So a simple definition of an uptrend in technical analysis is consecutive highs with consecutive lows. Okay, so if the stock market is doing that, so should the momentum index, the momentum indicator, again this one being the RSI. So when that doesn't happen, when you have the stock market going up with momentum going down, that's a negative divergence. That's showing the market is going up with very little conviction. So this chart goes all the way back to 1985. It just points out 4 times in history where the market went up without that momentum. It's showing that negative divergence. And right now we're in another one of those. So the last couple times it did this, it did it in prior to the 2000 drop and prior to the 2008 drop. However, I don't want you to take that, what I'm saying here, that we're going to have another 2000 through 2002 bear market or another 2008 bear market, and it doesn't mean that's going to happen now either. If you see here in the late 90s, the market continued to go up as we had a negative divergence for almost 4 years. Okay, so what it means though is that we have to be careful and we have to be prepared just in case that does happen. Okay. So there's a chance the market could continue to go up with a lack of conviction, but we just have to play it on the safe side, and when this happens, just know that we need to be careful. Okay, so another thing that we want to look at, that we constantly look at, it has a big, it is important to know, for one, bonds and the economy. Okay, so just recently, in fact it was Wednesday, 2 days ago, the Federal Reserve cut interest rates for the second consecutive time. And so now, since they've started cutting interest rates, they're now down 0.5%. So they cut them a quarter basis point or 1/4% a couple days ago, and right now we're between 1 3/4% to 2%. Okay, so and it looks as if you're following the federal funds futures rate, which predicts future interest rates, it looks like they're going to cut them possibly one more time. Odds are right now about 75% chance that they're going to cut interest rates one more time this year. So that would be three cuts this year. Okay, so that's one thing, and another thing is, as interest rates have been coming down, bonds have been going up, and that's been a good thing because we've reduced stocks and we've increased bonds, and specifically long-term government, U.S. government bonds, which have really gone up as interest rates have gone down. But some people may ask, can interest rates go much lower? We're reaching almost an all-time low in the 10-year Treasury right now, being at 1.79%. And my answer to that is certainly they could go lower. In fact, and I'm not saying this is going to happen, but in Europe right now, you can see on this chart here, the Germany 10-year bond is at negative 0.5%. And the Japan 10-year bond is at negative 0.21%. So, and even, out of all these 5 large countries, we have the highest interest rates of all 5 of those countries. So interest rates could certainly go lower. We think they are going to go lower, and that could be a good thing for bonds. From the standpoint of what that does, why the Federal Reserve would even do that, what they're trying to do is if they're successful at bringing interest rates down, that encourages people not to put their money in just a savings account, but rather to borrow and to buy houses, buy cars, or businesses to borrow and build new manufacturing plants because you could borrow much cheaper. So they're lowering interest rates to try to stimulate the economy. Okay, the last point I wanted to cover is market sentiment. So what is market sentiment? Market sentiment is a study of how the overall market feels, what their sentiment is about what's going on with the economy or the stock market. And it's usually a contrarian indicator, because in this case we're looking at the smart money, dumb money confidence. This is a chart put out by Sentiment Trader, and it studies what if the smart money is optimistic or pessimistic, okay? And it shows the same thing with smart money, if they're optimistic or pessimistic. I want to focus here on the dumb money. You usually want to do the opposite of the dumb money. And please don't take me as being condescending. These aren't my terms. This is Sentiment Trader's term. But dumb money is just your average investor who doesn't put a lot of research in. They're not a professional, and they're usually investing off of a whim. And fear and greed is a big driver for theirs. So when they get very greedy, or in this case optimistic, we want to be, it's a red flag. It means the market could be approaching a high. And this isn't a long-term indicator, it's more of a short-term indicator. But right now the red line, which is dumb money, is gone back into an extreme optimism standpoint. So last few times that's happened, the market has dipped a little bit in May. It's dipped a little bit here in July as well. You can see from a larger pullback was back in the beginning of 2018 when the market made a big drop. So again, it doesn't mean a huge drop is coming, but it means that short term the market is probably a little bit too high. However, there are other sentiment indicators, and I'm not going to show a chart for that show that the market is still very fearful. And anecdotally, I also hear a lot of people think a recession's coming, and a lot of people are scared about the market. And that's actually a potentially good sign for the market, because usually when the market takes a big drop, most people don't see it coming. Most people are very excited about the market. They think it's going to continue to going up. And right now you do have a large percentage of the population who is concerned about a recession coming. And so that's called, when the market climbs, a wall of worry. So if you do have a lot of worry out there, that's actually a good thing for the market. So again, these are contrarian indicators. So it's giving a mixed signal right now. It's not giving a very clear signal where the market's going to go. I will say seasonally, October is somewhat of a negative month. That doesn't mean every October is negative, but there are some famous market drops that come in October. I don't say that to scare you. The reason I say that is because I want you guys to know that when we see certain red flags pop up, we go defensive. Okay, we're doing that for you, and we have gone defensive. We've lowered stocks, the percentage of stocks. We've increased bonds, and we've even added a little bit of gold to the portfolio to just in case we have inflation. So we're taking measures to be defensive in case the market drops. However, the market could continue to go up, and if that's the case, we'll still do okay, but we may not make as much of the gain as the market does. But I say that because our investment philosophy is we manage risk first. So if we're going to be wrong, we want to be wrong by missing out a little bit on the upside than taking a big hit on the downside. So I hope this helps. If you have any questions, give us a call, and we'll see you soon.